Hi guys, welcome back to Xanyon channel. For those of you who have a stake in the tech stocks, the market has been down by at least 2 to 5% in a week's time. Some have even reached the lowest point in the 3 months time frame, just like Apple stock. The big players such as Facebook, Amazon, Apple, Google and Tesla are experiencing downward trend. Hence, the tech-heavy Nasdaq Composite Index, including the S&P 500, has been dragged down by the drop of these tech stocks. Many analysts relate this with the recent jump in the US Treasury bond yield. The 10-year Treasury yield has moved up from 1.13% to 1.6% since 10 February, which hit the highest level in a year. The bond yield is actually a monetary tool that the central bank, also the Federal Reserve, use to control the inflation in the country. Raising bond yield indicates the government's intention to lower the inflation. The rise in bond yield is a positive indicator for the recovering economy as the country has started its vaccination program. In theory, bonds and stocks are negatively correlated, meaning when one goes up, the other will go down. Why higher bond yield matters for investors? First, institutional investors are likely to divert their investment to other options of safer investment vehicles. For example, the lower risk bond compared to the higher risk stocks, although the return of bond is relatively lower than stocks. Investors are expected to relocate their portfolio back to the REITs or consumer staples industry in the expectation of the strengthening economy. Investors are now closely monitoring the latest development of the stimulus packages and very likely to redirect their investment back to the stocks affected by the COVID before, which are now cheap to buy compared to the overvalued tech stocks. Second, borrowing could be more expensive when the bond yield increases. Investors expecting a growing economy which will be accompanied by higher inflation and higher interest rate in the future. This will have a direct effect on most companies, particularly the tech industry, as they rely heavily on borrowing for growth. If the borrowing interest rate increase, they have to pay more for the cost of funds, pay more for the interest to borrow money, which will hurt the company earning potential and profitability. That's our 2 cents. Hope you enjoy our video content. Do subscribe and leave a comment if you have any other thoughts. See you again in the next one.